Silver investors, if you think yesterday's $6 slam in the price fixed anything, I've got bad news for you. Paper was neutralized, metal was not. I'm OG John AG style here. No courses, no private group, no affiliate links. Just what actually happened when CME halted metals, why open interest collapsed, how India quietly broke from London, and why 54 million ounces draining in 30 days matters more than any one candle. Segment 1, what CME really did to March silver. Let's start with the move everyone saw, and what almost nobody understood. In one session, March silver open interest collapsed to about 10,500 contracts, down more than 11,000 contracts from the day before. That's over a 50% reduction in March exposure in a single day, taking potential delivery obligations from roughly 110 million ounces down to about 53 million. Then came the Wednesday halt. Metals trading on CME was frozen for roughly 90 minutes. While most retail and slower players were locked out, over 31,000 silver contracts still changed hands during the window when price was being repositioned behind a black screen. When the lights officially came back on for everyone, silver had already been slammed about $4 lower, and further waves drove it roughly $6 down from the 91 area into the mid-80s. On the surface, that looks like heavy selling. Under the hood, it looks like this. The exchange helped clear a massive chunk of March delivery pressure. The market reopened at a lower level, with longs shaken out and the most dangerous near-term claims pushed further into the future. They didn't fix silver. They bought themselves time. Segment 2, tape reading. 150 EMA bounce and swing failure. Now forget the narrative and look at the tape. Before the halt, we'd been watching a key 150 EMA on the hourly chart as a confluence level. After the engineered flush, price dropped into the 85 zone and bounced exactly from that region, back into the high 80s. Two things lined up, hourly 150 EMA acting as dynamic support. A classic swing failure pattern, take Tuesday's 9 a.m. low, draw a horizontal line. Price purged below that low on the slam, then closed the candle back above with follow-through to the upside. That's not magic, that's structure. Tape reading is not predicting the future, it's marking levels in advance, watching how price behaves when it gets there. Letting the reaction tell you whether a move is exhaustion or ignition. You saw a violent flush into a pre-identified level, a sweep of obvious lows. Then a move higher from 85 to around 88, with the pattern confirmed. That's how professionals separate engineered shakeouts from genuine distribution. Segment 3, what the rug pull cost them in the vaults. Now the part you will never see on a price-only chart, what happened in the vaults while everyone was staring at candles. On the same day CME halted metals and reset the tape, COMEX vault data shows about 1.3 million ounces of silver left the system. Breakdown by vault. Around 218,000 Oz adjusted out of Brinks registered. Roughly 624,000 Oz withdrawn from HSBC. About 25,000 Oz out of JP Morgan. Around 619,000 Oz from MTB. Net result? Registered silver now sits near 86.1 million ounces. Total COMEX silver inventory around 361 million ounces. Here's the killer statistic. In the last 30 days, about 54.5 million ounces of silver have left COMEX. Roughly a 13% inventory decline in 1 month. You can manipulate paper. You cannot fake metal walking out the door. Segment 4, coverage ratio, the math that doesn't work. Now put the paper stack on top of those shrinking ounces. Using the current numbers, registered silver covers only around 60% of 1 month's worth of open interest in the front contract. Registered divided by open interest gives a coverage ratio of roughly 0.14, meaning there's physical backing for about 1.4 contracts out of every 10. In other words, for every 10 paper claims, only about 1 to 2 contracts worth of real metal is sitting in the ready-to-deliver bucket. That's what people mean when they say the math doesn't work. Even after CME cut March open interest by more than half, you still have a thin registered pile, heavy paper exposure, a structure that relies on most longs not asking for delivery at the same time. They survived March, for now, by reducing immediate claims. They did not rebuild the collateral. Segment 5, Shanghai versus West, the real price of metal. While Western traders got halted and flushed, Asia just kept paying up. Right now, Shanghai spot silver is trading around $97. Shanghai futures are around $100. Western spot is around $88. That's about a $9 premium for real metal in Shanghai versus the global price printed in New York. Notice what did not happen. When CME slammed silver from 91 to 85, Shanghai's premium did not disappear. The gap persisted through the halt, the wipe, and the bounce. If this were a simple arbitrage glitch, aggressive players would close that premium quickly. But they can't. Capital controls, export limits, logistics, and political constraints block clean arbitrage. So the message from Shanghai is simple. Physical buyers in Asia are willing to pay more than the Western paper price for immediate metal. That premium survived a textbook washout on CME. The real silver market is not agreeing with the number on your Western screen. Segment 6, India quietly breaks from London. Now at a second front, India. Regulators there just did two huge things at the same time. They allowed around $385 billion in actively managed equity fund assets to allocate up to 35% into gold and silver instruments, ETFs, ETPs, and other precious metal products. That's institutional capital getting formal permission to rotate hard into metals, not retail, fund managers. Starting April 1st, Indian mutual funds must value their gold and silver holdings using domestic exchange spot prices, not London Bullion Market Association (LBMA) prices. That means no more automatic reliance on London benchmarks. Valuations will be tied to Indian market prices in rupees with local factors baked in. This does two things. It decouples a major market from Western price setting. It moves real-world price discovery a little further east. As wealth moves east, price discovery moves with it. India basically said, we'll set our own mark for our own funds. London is a reference, not a boss. In a world where Shanghai pays a premium. India values metals off its own exchanges. The LBMA-True-COMEX combo looks less like a global referee and more like one regional pricing node among several. Segment 7, Jane Street SLV, and how the game really works. Now let's talk about who is positioning where. In Q4, Jane Street quietly became the largest holder of SLV, adding around 20.6 million shares and pushing their position to roughly $1.3 billion. At the same time, Jane Street is in the spotlight for a completely different reason. A lawsuit linked to the Terra Luna collapse alleges that a Jane Street trader created a private chat called Bryce's Secret with Terraform insiders. They got material non-public information about Terraform's liquidity moves. Within minutes of Terraform pulling $150 million UST from Curve's 3 pool, a Jane Street wallet pulled another $85 million, the largest transaction the pool had ever seen. Combined $235 million functionally front-ran the collapse, before the public had any idea the peg was under pressure. Days later, the same people allegedly offered to buy distressed assets, Luna BTC, at steep discounts while retail accounts were imploding. Terraform's administrator has already sued Jump Trading for $4 billion over similar alleged behavior. Now Jane Street is in a second complaint describing the mechanics in detail. Why does that matter for metals? Because it shows you how information asymmetry works, how large players can act before the public sees anything, how the same firms that dominate crypto market making are now sitting on billion-dollar positions in silver ETFs. If you see, retail halted out of CME metal trades, a thin registered pile, a giant market maker long SLV. You should at least ask who is being positioned where on the board and who gets left holding the bag when volatility hits. Segment 8, what they can do versus what they can't. Let's be brutally clear about the two columns, control versus no control. What CME and the big participants can do. Keep rolling near-month contracts into May, July, September, pushing delivery pressure forward. Halt trading again if needed. Wipe order books and flush over-leveraged specs whenever the structure looks unstable. Raise margin requirements, making it harder for smaller players to hold large positions. Use cash settlement tools, incentives, and quiet deals to reduce how many people actually take delivery. What they cannot do. Stop 1.3 million ounces from leaving vaults during a trading halt if participants truly trust the system. That exit tells you trust is already damaged. Erase a persistent $9 Shanghai premium with clean arbitrage if there are no real constraints. The fact it holds shows structural separation, not a 30-minute glitch. Force India to keep using LBMA benchmarks when Indian regulators have already set a date to switch to local exchange pricing. Turn a coverage ratio of 0.14 into a healthy number without either adding metal or slashing open interest again. Reverse a 54.5 million ounce 30-day inventory drain with PR statements. Paper tricks buy them time. They do not manufacture metal. Segment 9. The honest delay scenarios. No hopium here. Let's lay out the ways this can take longer than people expect. CME keeps doing exactly what they just did. Roll contracts, halt markets at key moments, and force more players into cash rather than delivery. Shanghai's premium could narrow if Chinese industrial demand eases or if Beijing temporarily slows buying. India's shift away from LBMA benchmarks might roll out gradually without fireworks. Another wave of macro risk-off could hit all assets, triggering forced selling in silver along with everything else. All of that can delay the big repricing. What it cannot do is permanently square a system where registered covers only a fraction of open interest. Inventories are shrinking double-digit percentages in a month. Asia and India are clearly willing to treat silver as a strategic input, not a toy. Segment 10, what actually matters for you. Here's what matters once you strip away the drama. CME succeeded, in the narrow sense. They cut March delivery exposure by more than half and survived this month's immediate squeeze risk. The cost was obvious: a vertical engineered slam, a 90-minute halt, an order book wipe, and another visible hit to their credibility. At the same time, silver still trades around 88 instead of collapsing into a death spiral. Shanghai still pays about $9 more. Around 54 million ounces still left COMEX over 30 days. India just greenlit hundreds of billions of potential flow into metals and decoupled its pricing from London starting April. The last time they pulled a similar stunt in late November, silver ran roughly 120% higher over the next 2 months. That doesn't guarantee a repeat. It just tells you what level of desperation preceded the last big move. This is financial warfare education, not advice. Your edge isn't guessing whether silver ticks up or down tomorrow. Your edge is knowing how the plumbing really looks, who can get halted and who can't, where the real bids are: Shanghai, India, industrial users, and big SLV holders, versus where the screen number is being pushed around. If you watch this far, you're not here for hype. You're here because you want to understand why the math doesn't work, not just hear that it doesn't. Use that.